And there you have it, the final closing bell of the week this March 25th. Let's take a good look now at how the markets closed the day, the major indices. A mixed bag there. We're seeing the Dow up 153 points, up 0.44%. The S&P 500 also in the green, up 0.5%, up 22 points, almost 23. But the tech-heavy NASDAQ, the only one in the opposite direction, that's down slightly, just 0.16%, down 22 points today. Well, let's bring in our market panel to digest all the happenings today with the markets. James Liu, Clearnomics founder and CEO, and Megan Horneman, Verdence Capital Advisors Chief Investment Officer. Welcome to you both. James, as you look at what happened here, this mixed bag with obviously the very tech-heavy NASDAQ there, not quite making it into the green, what are your thoughts about some of this volatility we're still seeing there?
Yeah, Rochelle, it's a great question because really we're seeing a lot more stability since the Fed meeting last week. You have the market up 2 weeks in a row now. Since the bottom, the NASDAQ is up, about 12%. The S&P is up about 8%. And really what's happening is that some of the uncertainty that was taking place in terms of what the Fed would actually do, that's gone away. And it's gone away in the direction of what the market had not just expected, but had wanted the Fed to do in response to inflation. And then you also have oil prices, which had been obviously rising over the course of the last month, and those seem to have basically fallen into a range. So what investors seem to be hoping is that there's a lot less kind of unknown unknowns out there in the market. And really, we're back to worrying about whether inflation is going to get resolved and obviously watching what's happening in Ukraine over the next few months.
Yeah, it doesn't look like any resolution there. And Megan, really the same question to you, your big picture takeaways on the week that was and where we're headed as we go into next week, given the news from the Fed.
Yeah, I think what you've been seeing is really this kind of resetting and repricing the Fed expectations. Right now, you have more than an 80% chance that the Fed's going to raise by 50 basis points in May. And just keep in mind that 2 weeks ago, that was basically zero. So the big news this week has really been what's happening in the interest rate market. We're seeing that repricing of the Fed expectations, and it is filtering into some of the different areas in the equity market. Like we said, we've gotten some stability in the market this week, which is great, but you are still seeing some expensive areas of the market that aren't keeping pace. Some of the tech, especially today, you're seeing a bit weaker as well.
And Megan, I want to follow up on the Fed with you. I'm just wondering, at what point do they break the market? Because there's been a lot of chatter about 50 basis points now for May. It almost seems a lock, and the market seems to be able to digest it. But we're also talking about future 50 basis point hikes, also talking about balance sheet reduction. What's the breaking point, do you think, for the market?
Honestly, at this point, I think the market would, the breaking point for the market to the downside would be if the Fed doesn't deliver on some of these actions that they're putting forth in the market. They kind of got a little bit of flexibility with what was going on with Russia and Ukraine earlier in this year, and they were able to just go 25 basis points in March. But investors are fearful that they're behind the curve. So if they decide to take a pivot again to a dovish stance again, I think that would disrupt the equity markets.
And James, I want to bring you in here because in your notes, you talked about supply chain disruptions obviously being an industry by industry story. With that in mind, which investments are in a better position to really weather this period as we do have these concerns about COVID outbreak in Europe and some of these spots popping up in China as well?
Yeah, well, Rochelle, when you look at on a sector basis, really there are the sectors that, of course, take advantage of supply chain disruptions and higher prices, as well as higher commodity prices that benefit directly from higher inflation. So, clearly energy is the big winner so far this year. You see that in commodity indices as well. But, as we kind of come out of this, especially as you see those inflation rates start to come down a little bit, they're still going to be high on an absolute basis, but that potentially benefits consumer sectors, tech sectors, and other more cyclical areas of the economy as we kind of get back on sure footing in terms of economic growth. And so those areas have been hurt hard this year, especially with the impact on consumer wallets. But we think that in the second half of this year, if inflation really does start to turn over and stabilize a bit, then those will be areas that could benefit.
Megan, you referenced the switching tone from the Fed. Would you like it if they acknowledged that they were behind the curve? And how long do you think before their action begins to bring down inflation?
I think they already have done that. You've seen them take a very big pivot in their speech, and they have kind of admitted they've gotten inflation wrong. So you have seen that, and you've heard that rhetoric from the Fed already. I think that inflation is also being driven by other factors that are going to take time to heal. Part of that is the supply chain disruption that we've talked about. Remember, supply and demand, if you get some pullback in demand, which we are seeing from the consumer side in the first half of this year, then maybe it can give some time for the supply side to catch up. So this is really kind of not just the Fed on its own, it's also some of the dynamics in the economy that need to work their way out. I still think this is the second half of this year into 2023 story.
And James, I want to get your thoughts on inflation, the big discussion topic of the year here. With prices soaring, there are what are known as substitution effects. People buy cheaper products, alternative products. High gas prices eat into people's wallets as too, make them start thinking about alternatives to their normal daily routine. I was asking, when does the Fed break the market? When does inflation break the consumer here?
Yeah, that's a great question. And really, it goes back to the traditional economics, so short run versus long run. In the long run, yes, there are substitution effects. Consumer preferences change. They change their consumption baskets. You guys were talking earlier about shifting to electric cars. That's all in the long run. In the short run, though, very few of those changes can happen, especially when you have such big shocks like we've seen over the last year and really over the last month with oil prices spiking. And so what you expect to see there is that it already is impacting consumer pocketbooks. And, the consumer sentiment number we got today is still hovering around the lows that we've seen in years, and that's affecting expectations on consumer inflation at about 5.4% over the next year as well. So there's unfortunately not that much we can do in the short run, other than the fact that consumers have been in a good spot over the last 2 years because their savings rates have been high and their balance sheets have been strong. So it's really in that longer run area that consumers and overall the economy can do something about this. And what we hope for, of course, is that oil prices will stabilize, and that over the next year or so, you start to see inflation kind of roll over and tick down. But again, it's a challenging situation. This is why many investors and economists hope that the Fed would raise rates to prevent an inflation spiral. And that's so far what we've seen from them.
And Megan, as some of these high prices do then continue to bite the consumer on top of all these other headwinds, what do you think of the expectations then for the next earnings season?
I think you still have some time before this is going to filter into the earnings, the actual earnings themselves. I think you'll still get a decent earnings season this season. But the bigger question is going to be, what are the expectations from the companies? I think the market will move more on the guidance that they give going forward, whether they're seeing some impact at the consumer level, what they're seeing from the labor market as well. That's been a big concern from the company level. And then also from the supply chain side of it. What does all this mean going forward? And I think that people are trying to get their heads around what earnings for the second half of this year and into 2023 will look like. I think we'll get more information when we get some actual company reports throughout the month of April.
James, taking all this into account, is there a soft landing for the economy, or could it trip into recession next year?
Yeah, well, Dave, we think the story is very different from the U.S. versus Europe. Europe, of course, they're on the front lines. They're hit hard by the conflict over there, by the energy spikes, and so very likely, there's a much higher chance they'll face a recession. In the U.S., recession is really just 2 negative quarters, and there's no definition as to how big those negative quarters have to be. Overall, though, we think the U.S. is still in a fine spot. I mean, that's the challenge with being an investor today. You have all these big shocks. You have uncertainty around the Fed. You have high inflation. However, the underlying demand engine of the economy, the underlying strength of the economy is still very much there. And so if some of these shocks can fade over the next 6 to 12 months, then the economy, we think, is still in a great place. And for markets, unless there is a recession, markets typically recover from corrections within 4 months. And, arguably, we've already seen some stability and some turning around in the markets just over the last 2 weeks. So overall, we think the U.S. economy is still in a solid place. That's kind of been the story over the last 10 years in terms of the U.S. relative to the rest of the world. And we think that'll likely continue.
A big thank you there to our markets panel, James Liu there, Clearnomics founder and CEO, and Megan Horneman, Verdence Capital Advisors Chief Investment Officer. Thank you for joining us this afternoon.